If I told you there's a way for you to get paid $3,000 a month the rest of your life, would you do it? So that's exactly what a fixed income annuity is promising you. Let's talk about it. Here's how it works. You give the insurance company a chunk of cash or money through a series of payments. And in return, they will give you a guaranteed amount of money every month. There are several types of annuities, such as fixed, variable, and index ones. But today, we're only going to be talking about fixed income annuity. So with a fixed annuity, no matter what happens to the stock market or inflation, you will still get the same amount of money every month. Say you have a $3,000 annuity, even if the stock market crashes tomorrow or inflation goes up 15%, you're still going to be getting $3,000 every month. Think of this as kind of like your own personal pension plan that you have created and paid for. So a lot of people use annuities to really fill in the gaps between Social Security and other retirement plans that they have. Let's talk about the pros and cons, right? A really big pro of an annuity is it's highly customizable. You can pay with lump sum, you can make different payments, you can denote your beneficiary, and unlike a 401k or IRA, there is no limit on how much you can put if you're contributing to a non-qualified annuity. So you're probably thinking, this is probably too good to be true. Yes, there are definitely drawbacks to it. You know, even though a fixed amount is great, it really comes with two negatives. The first big negative is that there's no inflation protection. So that means your buying power would decrease as time goes on if inflation keeps going up. Also, you won't be benefiting from the stock market growth. For instance, if the stock market goes up 14% in a year, you won't be benefiting from that, and the amount of money you get will still stay the same regardless. The other big drawback from annuities is that there are a lot of fees that are associated with it, and those fees are usually higher than a regular 401k or an IRA. Another thing is that you won't be able to easily access the money in an annuity for a big purchase that comes up or any emergencies, because there will be penalties involved if you withdraw the money. If you withdraw the money more than a specific amount during the surrender period, you will have to pay a fee. And since annuities are mostly designed for retirement, there will be a 10% IRS penalty if you withdraw the money before you're 95 and a half. As you can see, annuities are complex, and this can be a big con for a lot of people because it's not as straightforward as a 401k, IRA, or other types of retirement vehicles. However, I don't think there's a one-size-fits-all when it comes to retirement and investments. I really think that you should determine what you value, what is going to be the most important for you when you do retire. Follow to learn more about personal finance and economics.